Today I would like to talk to you about inventory errors. In general, if I were to bet 100 Monopoly dollars on any topic that you will for sure see as an auditor or just in financial accounting, that will be correction of errors. Everybody makes mistakes and you have to correct them. And one very popular one will be inventory error. In fact, I still remember when I was a brand new accountant or auditor taking inventory, I miscalculated it because there was pallets and boxes on the pallets. And I just said, okay, it's 5 by 9 of them, it must be 40. And then the accountant was standing next to me and he said, wait a minute, but did you count the ones that are inside? Because you got to think volume, not just the area. Like, oh yeah, you've got a good point. Otherwise, it would have been off. So let's see how it works. And I usually try to draw things out for the students, especially with inventory. And then as I was coming around, checking one of the exercises we did, I came across this wonderful drawing. So this is not mine, and it is dedicated to a wonderful student of mine who graduated a couple of years ago by now, and her name is Alyssa. So this is Alyssa's drawing. Let's take a look. What do we have? Just a reminder how inventory works in general. So we have beginning inventory, right? Then we're going to add purchases. The two together will give us goods available for sale. This is max that you can sell. If you sell out everything, all of these, they will be transferred to cost of goods sold, and there will be nothing left in ending inventory. However, if we don't sell everything, you will have an ending balance right here. Okay? So let's take a look at this. This little pizza represent goods available for sale. Okay, goods available for sale. These goods available for sale consist of two parts: ending inventory, here's the slice of ending inventory, and cost of goods sold or eaten. So we're gonna split it into this little piece and then cost of goods cost of goods sold. However, imagine for a second that we took inventory count and we ended up miscounting, and our ending inventory is larger than what the reality is. Okay, so for example, the reality is 10, I counted as 15, and as a result, I adjusted my books to 15. Okay, thinking that 15 was correct. You can see visually what does it do to your cost of goods sold, because goods available for sale is correct. So now that split between ending inventory and cost of goods sold is wrong, and ending inventory gets into cost of goods sold, and now this part is understated. Okay, so you have to be very comfortable thinking through this little diagram at the bottom. So what does it say? If your ending inventory is overstated, like in this case, your cost of goods sold will be understated, too little. And you do know that cost of goods sold, it's an expense. It is related indirectly to net income. And as a result, your net income will be too high. Fewer expenses, meaning you will have higher net income. And net income, once you close it, will also cause an error in your retained earnings, and your retained earnings will be also overstated. Okay, let's take a look at the next year. All right, here we go. We're going to move all the way to this pizza. So this is goods available for sale next year. Okay, except this extra slice of inventory error that was an ending inventory now shows up as an extra glob on my pizza because it is now beginning inventory. So ending inventory that was incorrectly recorded as 15, so 5 extra, became beginning inventory. So beginning inventory is too high, and your cost of goods available for sale is not correct. Okay? At the end of the second period, you're going to count inventory again. Okay, so this time you counted it correctly, so ending inventory is correct. But look at this. Even though ending inventory is correct, it's beginning inventory that messes up your cost of goods sold, and cost of goods sold appears to be overstated due to this large piece of dough or cheese. So it will look like this. Beginning inventory is overstated. As a result, goods available for sale, this big pizza, is misshapen. It's overstated. Okay? As a result, your cost of goods available for sale is overstated as well. And always remember it has adverse relationship with net income. As a result, net income will be understated. Okay? And once net income is closed, now be careful. Retained earnings is a permanent account. So it will not only have the effect on the current year, because yes, net income will be little for year 2, but if you compare year 1 and year 2, cumulative effect will be 0. So this is a counterbalancing error, meaning it will self-correct in 2 years. So retained earnings were overstated the first year. In the second year, the ending balance will self-correct and there won't be any error left. Okay? I hope it makes sense. And pretty much the inventory errors will work that same way. I would suggest maybe drawing it out and writing this stream of the effects somewhere so you can keep track of what is going on all the way through the retained earnings as well.